What's up, investors? We're in a crazy bear market. There's ups, there's downs, and it's really scary. This is not a time to run away from the markets. This is a time to do our research, focus on the companies we want to own, and figure out what prices we want to buy them at. Today, I'm talking to you about Deere, Google, and NVIDIA. These are three high-quality stocks that have beat the market over the long term. I'm going to tell you, we're going to compare and contrast some of the differences between the three in profitability, growth, price to earnings multiple, and I'm going to tell you exactly what prices I would buy each of these stocks at the end of the video. So stick around all the way till the end. All right, so first up, let's look at kind of some of the core metrics of these companies, right? You've got John Deere, which is a $124 billion market cap. It's got 75,000 employees. Then we've got Google, which is a $1.24 trillion market cap with 186,000 employees, and then NVIDIA, which is right there in between, 376 billion at 22,000 employees. So just this, looking at this number, these numbers right here alone, what we can see is that John Deere is a much more employee centric. They need more employees for their business, right? We're talking about $124 billion in market cap, 75,000 employees, whereas Google's about 10 times the size in market cap and only, double to 2.5 times the amount of employees. And then NVIDIA is about 3 times larger in market cap and 22,000 employees versus 75,000. So we know just from looking at this that John Deere is going to be much more prone to things like labor strikes and stuff like that, just because they're in the industrial sector and they're very employee heavy. That doesn't make it a buy or a not buy, but that's just something to remember. Okay, and we can see which one of these are kind of trading with momentum and not with momentum right now. So we can see John Deere price compared to its 52-week high. It's only 6%, almost 7% down from its 52-week high. Google is 36% down from its 52-week high. NVIDIA is 52% down from its 52-week high. Off the lows, Deere is up 46%, Google's up 16%, and NVIDIA is up 48%. So what this tells me is that NVIDIA is very volatile, right? It's down 52% from its 52-week high, but up 48% from its 52-week low. That's a huge difference. And then John Deere has actually been surprisingly volatile too, up 46% off its 52-week low. And really, we can see the last 6 months for John Deere have been extremely strong, up 33% versus Google down 10, NVIDIA down 4. And what's surprising to me is actually how strong John Deere has been over 3, 5, and 10 years. So over 3 years, it's up 147%, beating Google, losing to NVIDIA. 5 years, it beats Google and NVIDIA, up 210 versus 84 and 201. And then over 10 years, up 517%. Google's up 482, and then NVIDIA's up 5,774%. When it comes to dividend, the only company here that pays, a relative dividend at all is John Deere. Right now, its forward dividend is about 1%. 22% payout ratio, which makes that dividend pretty safe. They've got, room to keep paying and growing that dividend. It has been a dividend grower, which we know over time, companies that grow their dividend tend to outperform the market. They've grown it at 13% over the last 3 years and about 13% over the last 5 years as well. If we look 3 years out on a price earnings basis, John Deere's at 15, Google's at 15. I think that's great. That's fair. It doesn't look extremely over or undervalued. But then NVIDIA's at 28. The market, the S&P 500, generally trades between 15 and 18. So a 28 PE 3 years out means that it has a premium, certainly, and a lot has to go right for NVIDIA to work out as a long-term investment. Now, it's a very strong company with really compelling industry with great management, but we still need to buy it at the right price. And so that's what we're trying to figure out in this video. And here's the thing. Deere is expected to grow revenue looking forward at 17, 18%. Google's at 19 and NVIDIA is only at 21. And so, really starting to come into question whether NVIDIA deserves its premium or not. Now, granted, over the last 5 years, John Deere has grown revenue at about 12% a year, Google at 22, and NVIDIA at 26. So it has been the strongest revenue grower over the last 5 years, for sure. Okay, now let's look at some of these profitability metrics, and this is where kind of that high people cost and high capital intensive cost for John Deere is going to really start to show. So gross profit margin is 27% for Deere, 56% for Google, and NVIDIA edges them out at 58%. Net income margin is very strong for all these companies, but again, you could see these software type companies really shine here. John Deere's at 13, Google's at 24, and NVIDIA's about 21. And here's what I was talking about, right? John Deere, $81,000 in net income per employee. Google's at $358 and NVIDIA's at $265. All right, so what I want to show here is we talked about that 5-year return, right? Like you would never think that John Deere has outperformed NVIDIA and Google over the last 5 years. But this is why it has outperformed. It's about price. It's about earnings growth, sales growth, but then buying it at the right price. So 5 years ago, in November of 2017, you would have been able to buy John Deere at about a PE of 19.95. Today, it's trading at a PE of 18. The shares, according to this right here, are up 220% over the last 5 years. How did that happen? Well, the PE stayed about the same, but the earnings growth rate has been between 22 and 23%. And so the earnings growth rate is the rate at which the share price has increased because the price to earnings multiple has stayed essentially the same, 20 down to 18. It's actually dropped by about 10%. Now, when we look at Google, this is why that 5-year return is better for John Deere. 5 years ago, it was trading at a PE of 29. Today, it's trading at a PE of 20. That's about a 35% reduction, something like that, in price to earnings multiple, which means that the earnings growth has to be a lot stronger to make up for that multiple compression, is what they call it when you trade from a higher PE down to a lower PE. And this is what caught a lot of investors, including myself, off guard with where price to earnings multiples and price sales multiples got to in 2021. So we do have to think about buying stocks at the right price, even if they're great stocks. And this is where my opinion and my approach has changed over the last few years because I got it wrong. So I'm trying to improve that moving forward. And so when a stock is trading at a PE of 28 to 30, you can't think that over 5, 10, 15, 20 years, you're going to get multiple expansion. It's not going to go to a higher price to earnings multiple. Most likely in normal markets, normal healthy markets, it's not going to expand a lot beyond that. What you're going to have to get is enough growth to make up for the multiple compression of that price to earnings multiple going down. This is going to factor into our pricing model that we do at the end, where I tell you the prices I would buy these stocks. And then NVIDIA is the same example. NVIDIA has outperformed Google over the last 5 years, but John Deere has outperformed NVIDIA. Over the last 5 years, it was at a PE of 50, currently trades at a blended price to earnings ratio of about 46. And so that's come down. There's been insane earnings growth. You see earnings has grown at about 31% per year, but your annual return is only 205% because of that multiple compression. Now, my question and the challenge with NVIDIA here, will earnings grow fast enough to make up for the multiple compression that is going to come from this PE ratios going down? It is not going to trade at a 45 PE ratio 5 and 10 years from now in a normal market. And so what I've done, and I have no idea how these are going to come out because I haven't looked at them yet, but what I've done is I have built a low, a medium, and a high scenario 5 years out based on analyst expectations for Deere, Google, and NVIDIA. The middle is pretty much exactly what analysts are predicting. The low is about 10 to 15% below analyst expectations in each number. And then the high is, 10 to 15% higher. For Deere, we're looking at a low of 5% revenue growth, medium 6.7, and then high of 8 with 13, 15, and 15 profit margin, free cash flow margin of 12, 12.8, and 12.8. Price to earnings of 16 at the low side, and then 19 for middle and high, and same thing with free cash flow, desired annual return of 10%. So I hit analyze, and here you go. It is telling you that if you believe the low scenario, you would buy at 365, mid scenario 516, and then high scenario of 545. Now to Google. So low side, we've got 8%, mid 10.8, high 12% revenue growth, profit margin 22 and then 24.6, free cash flow margin 22, 27, and then price to earnings 17, 20, and 20. I think it probably deserves a premium to the market on the high side just because of kind of the moat around the business. We'll hit analyze. Yeah, this one is showing that even in the low scenario, if you believe this low scenario to be true, which is pretty bearish in my opinion for the quality of company that Google is, you'd buy it at 95. It's at 97 now. To me, if you're willing to buy it at 95, you're willing to buy it at 97. In the mid scenario, you'd buy it at 136 and the high at 143. So, that's about 50% upside-ish to the high scenario that you'd be willing to buy shares at. All right, NVIDIA has the highest growth expectations. So medium is 14%, profit margin of 39.5. The free cash flow margin, 34%. price to earnings at 20 in the middle scenario, and then price free cash flow at 20. Low is 10% revenue growth, high is 16. And then with a lower profit margin in the low scenario, that's, things aren't going as well if it's the low scenario, so we want to be more conservative. Let's hit analyze and see where it comes out. And there you go. So NVIDIA is showing, if you believe these to be true, so take a look at these assumptions and then do some research and decide if you believe these are way too conservative, because right now it's showing that NVIDIA in the low scenario, it has downside to 71, or you wouldn't buy it over 71. Mid scenario 125, and then high scenario 135, right? It's at 164, so that's like 20% downside to the middle scenario. All right, if this mindset stuff and valuation stuff is valuable to you and you want to support the channel for free, just like the video, subscribe to the channel. It costs you nothing. And then let me know in the comments what stocks you want me to review or what you think some strong buys if we get more of a dip might be. Thanks.